All right, welcome everyone. We're going to go ahead and get started. I know a few people are still joining in. My name is Charla Roth. I am a partner here with Danable and McKee. I know you were probably expecting my partner, Vic Vaccaro. Unfortunately, he was called out as an expert witness to testify for a client today. So unfortunately, you've got me, but you're in good hands, I promise you. So today we're going to be covering understanding AE financial statements and key ratios. Hopefully we can get this to advance. So as I said, I'm Charla Roth. I am a CPA and a partner here with Danable and McKee. I am also a principal with Danable, McKee and Associates, which you may be familiar with. I have over 22 years of experience in accounting and consulting, particularly in the architecture and engineering field. I do a lot of federal acquisition regulation overhead audits. I work directly with the New York State Department of Transportation, doing contract closeouts and pre-awards. I'm very familiar with all of the accounting packages out there specific to your firm, such as Xera, Dell Tech Vision, QuickBooks, Clearview, etc. So we're going to jump right in. Oh, I guess they want me to tell you a little bit about Danable McKee first, so I'm going to do that. Danable McKee, we are a full-service CPA firm. We work in both tax and audit, again, specializing in architecture and engineering firms. We are headquartered here in Syracuse, New York. We have additional offices in Binghamton, Schenectady, New York, Auburn, and Tampa, Florida. However, we work with firms across the country from New York all the way to California. So with the capabilities of remote technology, we can service just about any of the firms across the country. We also have a sister firm called Danable, McKee and Associates. We have gained national recognition for one of the leading consulting firms within the AE industry. We focus on ownership transition and valuation of a business. So if you're ever interested in participating in one of our webinars associated with Danable McKee and Associates, please visit us on our website, dmconsulting.com. And after this webinar today, we will provide you a copy of this PowerPoint so that you will be able to have all these links for you. So today, what are we going to cover? So important questions that you need to ask yourself is, do your internal financial reportings provide you with all the information that you need to function most effectively to manage your firm? So when I ask this question of my clients and of other firms that I meet, the answer is typically no. So today we're going to walk you through some tips and tricks to make those financial statement packages a little bit more insightful to help manage your firm. Your decision making can easily be impacted by this better financial performance. So we're going to walk through some key tips to improve those. A lot of firms are not utilizing their accounting and software system to its fullest potential. So we're going to work with you on what are some ways to boost your usage of the reportings that you already have. A lot of the accounting software that you're using has built-in reports, dashboards, and so many of you are not utilizing those to its fullest capabilities. So we at Danable McKee can help you with those because we are experts at using those software. So external financial reporting, what does that look like? Internal compliance, how can your financial statements help with income tax compliance? And then, of course, what we've been talking about, internal reporting and analysis, managing your firm to maximize your profitability. So we have these financial statements that you probably get a copy of every month, hopefully every month. You get this balance sheet and this income statement, and you are wondering, okay, well, what do I do with this? Well, today we're going to really help you break that down, whether you're a CFO, a clerk, or the owner of the business. This is all going to apply to you and how you can make your financial statement package better for the end users. We're going to teach you how to apply other financial statement analysis methods, such as analyzing your business. And this is really just going to help you with the success mitigate failure and help you progress in your business. This is also a critical for each firm to understand and utilize all the detailed reports coming right out of your accounting system. We don't want to recreate the wheel. Most of even QuickBooks, if you're utilizing QuickBooks, that has some great reporting capabilities. Utilizing those rather than producing things in Excel, and that leaves room for error. So 5 great ideas that we hope that you walk away with. We hope that we can help you improve your basic financial statements. We hope to use ratio analysis and industry benchmarking and to encourage that. We want you to start including budgets and forecasts as part of your financial analysis. We spend so much time as a firm budgeting and forecasting, and then all of a sudden, January 1st, we stop looking at those budget forecasts because they're not part of our monthly routine. So really utilizing those budgets and forecasts as part of your monthly analysis. Evaluating detailed reports that should be produced, and consider who should be receiving those financial reports. It's not just your accounting departments. It's not just your partners, project managers, whether there's other technicians that should be receiving financial packages. Maybe they don't receive everything, but they should understand some basics of how the firm is performing. And lastly, perform analysis. So don't just spit out all these reports every month. Let's take a step back, perform an analysis of what all of this means and how your business is actually doing compared to budget, compared to industry, etc. And please, if you have any questions, the Q&A is available, or the chat function. Feel free. I'll try to answer them all during the presentation or at the end. If I don't get them to them all, I'll email you all specifically. All right. All right, so let's dive in. So we have this infamous balance sheet. You've all heard of the term, the balance sheet. So the balance sheet is really just a snapshot of your financial position at a specific point in time. So if I was to run a balance sheet as of 9/1 or 9/17 today, that would just be what it is right now. It's a cutoff date of the date that you run that report. So this is just showing your assets and your liabilities and your equity in the firm. So the simple formula of assets less liabilities equals your equity. That makes sense, right? Your positives, your negatives, what you owe, that's the equity of your business. Balance sheets for AE firms are not really significantly different than other businesses. So you're going to see when we get into the income statement, hopefully your income statement is tailored to your firm, and it's not just a generalized income statement that you would produce out of, say, QuickBooks. Some of the most significant assets on the balance sheet would be accounts receivable and work in process. So accounts receivable represents amounts billed to clients for the performance of their services. And you should always be looking at your receivables to ensure what's collectible, what's not collectible, and then reduce your receivables by an allowance for uncollectible accounts. So every month you should be sitting with your project managers and your team to look at these receivables to determine what's collectible and what's not collectible, so that you're not letting those receivables build. Work in process. So this represents costs that you're accumulating on contracts in progress. This is direct labor. This is direct expenses, reimbursable expenses. Work in progress is reflected on your balance sheet and should be reported at your fully billable value. So with work in process, this is something you should also be looking at on a monthly basis with your whole project team, determining what's good WIP and what's bad WIP, what can be billed, what's not going to be billed, what needs to be written off, what should be allowed for as a potential unbillable work in process. So those are all things to be thinking about in your balance sheet. This is a sample balance sheet. You've probably heard of an accrual basis or a cash basis. So as a taxpayer, you're probably on a cash basis taxpayer, but annually throughout the year, you should be looking at accrual basis financial statements. This would then have accounts receivable, work in progress, accounts payable, your accruals. That's what accrual basis accounting is. So this is what a sample balance sheet should look like. You've got your assets, you've got your liabilities, and you've got your equity. And you see how I have these percentages next to all my numbers? It's really nice to be able to see where your concentration of assets and liabilities are, and you can see that as a percentage of the total. And I also add in columns for a variance. Not everyone can do the math in their head. It's very nice to see what's up, what's down, and then adding that percentage of variance. So this is something that really adds benefit to your financial statements by just adding that variance column and the percentages. So let's talk about the income statement for a bit. So the income statement is a period to date summary of revenue and expenses. So if I was to run a income statement as of 9/30, if my year end was 12/31, it would represent January through September 30th. So that's 9 months ended. So it captures all the data within those months. The income statement is really different for AE firms, significantly different than a manufacturer or a retail entity. And I'm going to show you what that looks like. Because if your income statements do not look as I'm going to present to you, you should contact us and we'll help you redesign your income statements because they need to be specific towards your firm to really be able to analyze such as an AE firm. And I'll show you all of that. Bottom line net income or loss is not really for an AE firm the true representation of your profitability because you may have discretionary bonuses that are paid to the firm's owners at year end, as well as other discretionary expenses. And we can show you how to break those out to really understand what your true bottom line is before all these discretionary items. The proper income statement format is really essential in order to help you manage your firm and to also compare yourself within the AE industry. So what are these specifics? Gross revenue. So you've all heard of gross revenue. This is the gross fees billed to clients, including your reimbursables, okay? Whereas the term net revenue is defined as your gross revenues less your reimbursable expenses. So really, the most important number that you want to consider is your net revenue number, because this is really what you're earning. On the income statement, it's very important that you're breaking out direct labor and indirect labor. So direct labor is labor that's charged directly to projects based upon time incurred on projects at the billable rates established by your firm. So when you're getting into the financial statements ratios, really having the correct direct labor and indirect labor broken out on your statement is going to be so important for you to analyze your firm in comparison with industry standards. So if you were to look at industry standards, typically direct labor compared to net revenue is often in the range of 32 to 34%. It's really important that you understand where your firm lies. It's also really important, and if you attended my last webinar on FAR reporting, you have to understand that direct labor is just so important that your employees know how to charge their labor when they're doing their timesheets and that they're breaking it out direct and indirect so that you can fully analyze how chargeable your employees are, your profitability on that direct labor. Just because a labor may not be billable to a customer or a client does not mean you charge it to indirect. If it's applicable to a job, it's direct labor, whether it's billed or not. Contribution margin. So this is defined as the firm's net fee less direct labor and direct project expenses. So having a handle on your contribution margin, if you were in the manufacturing, this might be called your gross margin, but in AE firms, you call this a contribution margin, and it represents your contribution, good name for it, to cover your overhead expenses that you provide for net profit. So industry standards roughly are in the range of 66 to 68 for a contribution margin. If your firm's not within that range, something you want to take a look at. This is just, again, this is all based off of PSMJ, in our own industry analysis of where we see firms. Indirect expenses. So on your income statement, indirect expenses are going to be broken out separately. These are what you might call your overhead expenses. This is your labor overhead, payroll taxes, insurance, fringe, benefits, rent, marketing costs, office expenses. All of those things are overhead expenses, and those should be broken out from everything else. And we're going to show you how that looks. And then, as I mentioned before, so you want to understand what your net income is, what your profit is before discretionary items, because you may pay out bonuses to owners, etc. And you want to understand what your net income was before that. And that should be really easy to just pull right from your statement. Industry standard of a pre-discretionary net income to net revenue is really in the range of 8 to 15%. So if I was a manufacturer or a retailer, this is what my financial statement would look like. You've got revenue, cost of sales, gross profit, SG&A, and then operating income and other income. Okay, so if your statement looks like this, then we've got some work to do, because it should look like this. This is what your statement should look like. And again, you're going to get all these slides, so don't feel like you need to worry about seeing these slides too quickly. You're going to get a copy of all this. So remember how we talked about gross revenue and net revenue? You see how that's broken out? You've got your gross revenue on top, your reimbursable expenses subtracted out, coming to your net revenue, because that's your important number. Then I've got that direct labor number, my direct expenses, coming down to that gross profit margin, my contribution margin. Okay. Then below that, we've got indirect expenses, your labor, your indirect labor, vacation, fringe, etc. Coming down to a number that's net income before discretionary. Okay, we've got that $902,000. And then that's when I go in and I deduct the discretionary bonuses and profit sharing contributions, coming down to that final net income. So this really helps you understand what your operating income is before that discretionary. If you were maybe a manufacturer, you would probably include those discretionary bonuses right inside your SG&A. But here, as an AE firm, we would break that out to really highlight that. Statement of cash flows. So I think one statement that I see most often not used on a monthly basis is some sort of a cash flow statement. So cash flow is a huge issue for AE firms, because you're constantly worrying about, if you work for a lot of state agencies, when is that payments going to be made? So cash flow is sometimes very tight. And that's why it's really important to look at your cash flow and determining, where you're at month to month. Cash flow statement is really just a period to date summary of your sources of cash and your uses of cash. Another statement you may see or put together for your financial package is a FAR overhead rate. So if you work with a state or federal agency, you may have to provide a FAR overhead rate. At this point, you would want to maybe keep monitoring that overhead rate, less any traditional FAR adjustments you may have, to really calculate so that you're not caught off guard when your CPA firm comes in at year end and actually calculates your FAR, that you fully understand what your true overhead rate is as it is going to be reimbursed from the agencies. So the next step is how are we going to help you improve your financial statement analysis? So you've got to go beyond those basic balance sheets and income statements. Producing and printing for your owners a balance sheet and income statement is not enough. You've really got to go beyond that. It's a starting point, but we've really got to go beyond. We've got to start adding variances and adding some other items such as your budgets, adding some fluctuation analysis. We're going to talk to you a bit about common size financial statements and what that means, ratio analysis, industry comparisons. First up, fluctuation analysis. So this is one of my favorites because not everybody can do the math in their head. Like I said, you've really got to add that column to your financial statements. Add a column to show the period to period changes. So if you're doing year to year, do a variance change. If you're doing adding in the prior month to your financial statements, very helpful. Showing a variance column, showing the percentage change column, very, very helpful to the user of your financial statements that really doesn't have that financial savvy to do the math in their head like all of us accountants do. Use statements with fluctuation data presented. Okay, so again, just mentioned adding those columns and then understanding the differences. So I think that when you see this in paper, you really can help build the relationships of why things fluctuated. So if your cash is down, possibly receivables are up, and it's really clear when you see, cash going down, but receivables going up, that's very understandable. And in putting those fluctuation analysis in your financial statements are going to help. And I also tell my clients to also add some sort of a narrative. So you can make a little column to tick mark on the side, some things that stand out to you, and put a little comment on the bottom of the financial statement of what the reason is for the fluctuation. So you can kind of prompt those questions before they're even asked. Budgets and forecasts. So we spend all this time in November and December preparing these budgets and forecasting for the year. And then we put them in a drawer and we never look at them again. Well, that stops today. So we're going to use those budgets and those forecasts and really build them into our monthly financial statement product. So that's going to be something you're going to help with your goals. Add that in, add a budget column right next to the variances so that you can see, what is planned and performed, what's actual versus what you planned. Again, this is really going to help management respond timely if there's an operational issue and get it back on track. So again, spending so much time preparing those budgets and not using them. Common size financial statements. So you may have heard this term before. Common size financial statements are just statements showing only percentages rather than dollar amounts. Okay, so you can really see this is very helpful when you're looking at your expenses. So I like to look at expenses as a percentage of your net revenue or your gross revenue and really looking at that amount and seeing, okay, where's my concentration of expenses? What's my percentage of direct labor, indirect labor, fringe, occupancy? Some of these items, what is that a percentage of my net revenue? So putting together a common size financial statement that really looks at the percentage of a certain item. And same thing for the balance sheet. You can do this for the balance sheet. You can say as a percentage of assets, I can see, wow, my WIP is 60% of my total assets. I got to take a look at this because last month it was 40. So if there's a big fluctuation in your percentage of WIP to total assets, you'd want to look at that. So this is all really important analysis that you can help build on your financial statement package. Okay, so there was a question in your financial statement presentation, will you include labor burden in direct labor? And that is incorrect. You do not. So labor burden would be down below in your indirect expenses. Ratio analysis. So we're going to spend a lot of time today talking about ratio analysis and benchmarking because we have a lot of tools out there. Hopefully you all are participants and subscribe to PSMJ. It's a fantastic resource that will give you the breakdown of firms from 0 to 30, 50 to 100 and larger. Breaks it down by area within the country, breaks it down, if you're an engineering firm versus architecture. So really breaks it down and gives you benchmarking against other industries. It's a great tool, really, to see how your firm is performing against other firms. So financial statements can be analyzed using key financial ratios. We're going to walk through those. Financial ratios are just a numeric calculation involving a comparison of meaningful amounts to the financial statements. Now, ratios, I want to caution you, are obviously not an ends to the means in themselves, but they do provide insights into the operations of your firms. When you're benchmarking yourself against an industry, you can't expect that you're going to be perfect. You may own your building versus others do not. It's not common for architecture and engineering firms to own their own building. So your debt to equity ratio might be higher because you have a mortgage. That's something that is going to be different than maybe the industry standard. So you can't just look at ratios in a bubble. You have to think about what's specific to your firm in comparison to what may be for industry standard. So these ratios are going to serve as benchmarks. You're going to compare with the same ratios for the same firm for the previous periods. So utilizing where you were a year ago, this is something you're going to have to build upon. Comparing with some predetermined standard. So as part of your budget process, you may say, I have a net multiplier of XYZ that I want to achieve. And that's something you benchmark and predetermine that you want to meet that or compare yourself to that each month to see where you're at. Compare with the same ratios for other firms in the same industry, compare with average ratios for the industry within the firm operates. So again, we're going to walk through all of these. I utilize PSMJ. We'll show you some other surveys that you can utilize if PSMJ is not available to you. Ratio analysis. So financial analyst groups ratios into categories, which tells us about different factors of the firm's finances and operations. We're going to go through an overview of some of these ratio categories along with the formulas. So you're going to have this PowerPoint presentation at the end that you're going to be able to utilize these formulas to be able to set up your spreadsheets in order to start adding these to your financial statement package. All right, liquidity. I'm starting here because this is one of my favorites. AE firms, I mentioned it already. Liquidity is an issue. We want to avoid going out onto the line of credit. Monitoring these liquidity ratios is important on a sometimes daily basis. So these ratios provide an indication of your firm's ability to meet its obligations within the next 12 months. These are the current ratio, working capital, AR turnover, and work in process average. So what does that look like? So this, you've probably heard of the current ratio. Hopefully it's something you are all looking at. But if you're not, here's the formula. It's simply current assets over current liabilities. So current assets divided by current liabilities. And you'll see, I gave you an example here of, I did a 5-year analysis. I do everything in 5 years, love a 5-year average, added that to this. This can be like a separate spreadsheet that is attached to your balance sheet and income statement that is part of your package. Can be linked right to your balance sheet and income statement so that this automatically performs each month and it's easy. I compare it also to industry standard. Here I chose PSMJ's median standard. You can see that this firm is outperforming the industry, that their current ratio has grown quite a bit. Well, I guess you're going the other way. So it's 5 to 9. So it's actually declined if you want to look at it that way. So if we go from the left to the right, we've gone from 4.64 to 2.31. So I want to analyze what happened. Why are we declining? What happened that we used to be 4.64, now we're 2.31, and actually now we're behind the industry median. So what happened there? Next one is working capital. So working capital, very similar. looking at your current assets and your current liabilities. Excuse me while I take a little sip here. All right, so you're going to take your current assets and your current liabilities and subtract those out, getting to your working capital. So we're seeing here our working capital went from 978,000 all the way down to 743,000, excuse me. So what happened here? Why is my working capital declining? Similarly to the ratio here above, these two work hand in hand. It's just looking at it different. Sometimes people like to look at dollars. Sometimes people like to look at percentages. So it's all on who's your audience, but these are two great ratios. All right, so managing your liquidity is all about collections. So in billings, so this is your days fees in unbilled work in progress. So you've got your work in progress divided by the daily fees generated. Okay, so I'm billing roughly 13.75 as my every 13.75 days. Okay, industry standard is 19.6. So roughly, twice a month. So that this is very important, because if you're in this upper category of 30 days, that's a problem, because how often you're billing is going to be a reflective of your collections, obviously. So ensuring that you're burning and churning those bills twice a month is very important. So this leads right into your days fees and billed receivables. This is just your accounts receivable divided by the daily fees generated. So you will see accounts receivable are on average is 130 days. So you'd want to look at that, and it has improved, but industry standards at 66. So why is it taking us 130 days on average to collect? What's going on here? So we have seen some decline. We'd have to take a step back. Maybe we have a very large customer that pays every 120 days. Well, that certainly explains it, but we need to understand our customers and our billing practices and our collections practice, and ensure that we're trying to get into that industry standard, which is the 66 days. Leverage ratios. So leverage ratios are just a measure to the extent at which a firm's operations are financed by debt and capital. So leverage ratio is going to really provide you an indication of your firm's vulnerability in business downturns. We obviously had a big business downturn. Hopefully we're all starting to see a tick up, but this is all important ratios to look at to see where you stand in terms of your competitors. So debt to equity ratios and bank to debt equity ratios are good ratios to look at. So debt to equity is exactly what it sounds like. It's total debt divided by total equity. So you're looking at this firm. So this firm has a higher debt to equity ratio than its standard. So as I mentioned before, possibly you own your building. So you're always going to have a higher industry standard than others because you have a mortgage. So you need to look at that, and possibly you don't want to compare to industry. You just want to look at what you're doing year over year to see if you're staying within your means of where you want to be from a debt to equity standpoint. This other one here is your bank debt to equity. So this is just stripping out any payables, any accruals. This is really just your bank debt, looking at to see, are you out on the line of credit? Do you have a mortgage with the bank? That's really what this is looking at and comparing it to industry standard. All right, operating ratios. These are great ratios to really measure the firm's ability to utilize its resources to generate revenue and profit. Some resources include labor force, or it could be your asset base. So operating ratios measure the firm's ability to control your costs performing the services. All right, so the first one up, net revenue by chargeable hour. Okay, so this is taking that net revenue number. So remember, that's our gross revenue less any direct expenses, and you're dividing that by your total chargeable hours. So hopefully your accounting software is able to show you your chargeable hours, really looking at what your chargeable hours are running and what that net fee is compared to standard. So important. Standard here is running at about $122 an hour, whereas we're running on a 5-year average around 90. Within this past year, 91. So really understanding what our goals are, because this is what you need to make sure that is people are as chargeable as possible, and really watching this on a monthly basis to ensure you're making corrections in real time. This is another great one, direct labor cost per chargeable hour. So looking at this a little bit different, looking at direct labor by chargeable hours. So this is looking at your net revenue per chargeable hour is $30.29 compared to industry standard, which is higher of $38.70. So really understanding if I'm falling below that median, what's going on here. So did we have a lot of inefficiencies on jobs in the past month? Is that what's driving this to be lower? But really sitting there and analyzing where you're at for that. All right, another favorite of all of ours is the net multiplier achieved. So this is your net revenue divided by direct labor. So this is taking your net revenue and dividing it by direct labor. You'll see this is a very important item that you set up during your budget time of what this number is that you want to achieve, and comparing yourself month over month to where you're at. So you can see here the firm's at roughly 3.02, industry standard is 3.31. How does, but you can look that in past years you've been 2.96, 2.90. So you've grown in this area. So really understanding what you did to grow and where you need to do better and try to be up with industry standard. Very similar, this is the net payroll multiplier. This is taking your net revenue and dividing it by total labor. So this is direct and indirect labor. So net revenue divided by total labor. So this is looking at your total labor force and comparing that so that you can also not analyze just your chargeability and your direct labor, but what are you looking at as a firm in total with your total indirect labor as well. All right, chargeability ratios. This is just direct labor divided by total direct labor, direct and indirect. This is just looking at your chargeability. So this is a really, really important ratio to look at each month to see how chargeable your folks are, and are they meeting not only your standard, but industry standard. So here we're saying that our folks are chargeable, 61% chargeable compared to industry standard of 59, which is great. We're 61% chargeable as long as all those hours can be billed, right? Overhead rate. So we've talked a lot about overhead rate and all those costs, really analyzing your overhead by total direct labor. So taking your total overhead, that's that's indirect labor, that's your fringe, that's your burden, that's your rent, utilities, everything that's in that overhead category, dividing that by your direct labor, and that's your overhead rate. So you can see this firm's running at around 171%, pretty high compared to industry median, which is 162. Certainly not as high as the upper category, but you would want to analyze that because you'll see you roughly ticked up 2 points from the prior year, and you want to understand why that is. See if there's any outliers. All right, so net income before discretionary items. divided by your net revenue. So this is your net income before discretionary. So that's before your bonuses and profit sharing, dividing that by net revenue. So what does this ratio look like in comparison to industry standards? So are other firms making more money compared to you, not factoring in any discretionary items that are particular to your firm? So you can see this firm's running at 11%, industry standards at 20. So you would want to analyze that. You can see that you've had a nice uptick from, the prior years. You went from 7 to 6 to 8 to 9 to now 11. So that's great. What did you do to achieve that? And what can you continue doing to try to get to industry standard? So we talked a little bit before about your employees understanding on how to charge their labor. So ensuring that they are categorizing direct labor and indirect labor correctly, because if they do not, these ratios will be irrelevant to you. So when direct labor is classified in indirect labor into your overhead expenses, the following ratios are going to be affected: your chargeability ratio, your net multiplier achieved, and your overhead rate. So if direct labor is getting lumped into overhead, your chargeability ratio is going to go down, your net multiplier is going to go up, your overhead rate is going to go up. So it's going to skew those ratios. So you're not really going to know how your firm is actually performing. So it's really important that you're training your employees how to charge labor in their timesheets correctly. And it's not just your employees, it's your principals. They're often the biggest culprits of not charging their time appropriately. So on the opposite end, when indirect labor is classified indirect, the following ratios will be affected. Again, chargeability will go up, net multiplier will go down, overhead rate will go down. So it has the opposite effect. So ensuring that everyone is charging their time correctly to direct or indirect, it's very important. Staffing ratios. So we all have overstaffing concerns, and it's really important that we look at these staffing ratios on a regular basis to ensure that our firm is either in line with where we want to be or in line with industry standards. And if we're not in line with either of those, what are we going to do to adjust? Maybe it's conscious decisions because we know we are in a down market, but we have these trained staff. We really need to retain them. That's okay. We make conscious decisions that may go against some of the ratios, but we need to understand that we're making those and document that. So for this purpose, technical staff includes professionals who spend more than 50% of their time on chargeable projects. We consider non-technical staff, administrative personnel, accounting, IT, marketing, those who are spending less than 50% of their time on chargeable projects. So some ratios you can look at to help with staffing is your net revenue divided by total staff that you have on. So you can take your net revenue, divide that by your total staff. Looking at that dollar amount, that's basically what the revenue you're generating per staff. It's a great number to look at. All right, so your net revenue per project manager, this is great as well. What is on average, how much are on average, should your project managers be generating for net revenue? This is something that you compare. Who's an overperformer, who's an underperformer, something for you to analyze there. All right, so some targeted financial ratios. So example, you may have a target multiplier of 3.02. You may have a chargeability or utilization rate of 63. You may have a target overhead rate of 155. These should be included in your monthly accounting package to show where you're at compared with your own firm targets. So we've talked about industry targets, but we've also now here, let's build our own targets, because maybe we're very different in what we do. And we may do both architecture and engineering services, and our ratio is therefore not really comparable to PSMJ. Possibly we're in a very niche market, and we don't feel that PSMJ is really where we're a good comparison. So that's fine. Develop your own targets, but utilize them and monitor them. So this is, you're wondering, oh, okay, now how am I going to implement all of these into my financial statement package so that it looks nice and pretty for everyone to look at? Well, here is an example. This is a simple balance sheet. You can see I have 2 years very side by side. I even have my 6 months prior, and then I've got a few more years tacked on. Okay. I like a lot of data. If this is too much for your principals, that's fine. Cut back. Just do 2 years and 6 months. It's fine. But you can add up at the top very easily your current ratio, your days fees, your days in unbilled, your debt to equity. These are all really easy ratios that you can do by putting these in Excel. And this will be calculated on a monthly basis, on a quarterly basis, however you want to handle it. Income statement. So here, this is obviously the most important. I don't want to, undertalk the balance sheet, but income statement for any firm, obviously very important to monitor. So you've got all of these ratios that I've included at the top, the net multiplier, net payroll multiplier, your utilization, your overhead rate, before bonuses, after bonuses, all really important. And again, you see that structure, it's revenues, less reimbursables equals your net revenues. You got your direct labor, then you got your indirect expenses, and then coming down. And again, if you have discretionary items that you want to add a line into, you should do that and create more lines. I ran out of space here. And then personally, I like to add a little bit more value to that high end number of the overhead or indirect expenses. I do a little breakout of what's consisted in this overhead number: indirect labor, vacation, payroll, just so you can see that period over period. And again, if it's beneficial, including some variance columns to this, that's very important, the dollars. I've included some percentages. Again, a lot of different things you could do here. Industry comparison. So we've talked a lot about that. So in industry comparison, we look at other firm performance in comparison to yours. Once you identify a problem that maybe you're not performing to industry, you want to figure out what you need to do to correct that problem. Again, we can't use these ratios in a little box. We have to take them, analyze them, report back, and make action. So there's lots of steps, because we don't just look at financial statements one day and put them in a drawer and not come back to them until the next month. These are all things that you need to be working with and coming back to and making action plans. Otherwise, it's a waste of your time. So we talked about PSMJ a lot. Obviously, I use PSMJ so much. Risk Management Association, RMA, Industry Statistics, ZWEG. There's lots of filings for publicly traded firms if you feel like those are a good matchup. Again, making sure that you know your SIC or NISIC code, obtaining data for firms of similar size or type, verifying that the guideline firms are truly comparable. All really important in your industry comparison. In PSMJ in particular, ZWEG, they all do a really great write-up of what firms they have included and how to line up your firm best with their data. So this is just another sample spreadsheet I include with my monthly packages, really just putting this right there. So I've got my firm right here in sample architects. I've got the industry standard. I've got my AE standard. I've got an architectural standard. And then I have 21 to 50 employees. So I've really got all the PSMJ ratios right here at my fingertips that my partners can look at and really dive into and see where they stand, because they all like comparing themselves to everybody else. So giving them this will help see where they align and where they need to try to work towards. So detailed reports. So The basic financial statements, that balance sheet, income statement, are not sufficient to effectively manage your company. I've said this several times. A firm must analyze more than just its balance sheet and income statement and the high-level ratios discussed previously. Detailed reports must be utilized by personnel throughout the firm. So this is what we're talking about here. So there may be reporting that you give project managers specific, but don't leave them out of the mix. They're the ones out there doing the work, having direct correlation with how these ratios are being performed. So making sure that they understand and are on board with even the balance sheet ratios of your liquidity ratios, so they understand how important it is for them to bill timely, because that then affects your AR ratios of how quickly you collect. And when you don't collect, what that means, you're going down the line, you're having extra interest expense, that kind of thing. So really getting everybody that needs to be involved in the process. And again, they don't have to receive all the same information. Your partners, your principals may want a separate package, and that's okay. If you have sophisticated software such as Deltek Vision or Agera or Clearview, there are such nice dashboards that are specific for each category of an employee, whether you're an administrative employee or whether you're a project manager or a technician. There's different tools that everyone should be using within that software that is very accessible, so they can see all of these ratios and how everything is performing right there on their dashboard. One thing I should mention is also, if you have multiple locations, multiple divisions, different segments of your business, if your architecture separate from your engineering, if there are different segments, maybe there's specific clients or niches that you want to break out. Consider breaking those out into separate financial statement, income statements, to show how these different divisions or locations are functioning and how they're performing. All right, so some different categories of detailed accounting reports. So general ledger reports. So you may want to print off certain general ledger reports for certain members of your accounting staff, for some certain partners. There may be certain accounts you like them to look at. Maybe it's the travel and entertainment. Maybe it's the auto category. So they can kind of monitor what's going in and out of those accounts. Ledgers that are really important that you give out are your accounts receivable agings, your WIP agings, and your payable agings. Okay, so those may be included to your project managers. They show them who hasn't paid, show them the work in progress on their jobs. You know, sort it by project manager so that they can really dive right into their own jobs and not have to worry about everyone else. You know, looking at different journals, whether or not any sales or purchasing journals or cash disbursements. You know, maybe there are principals that want to look at the different cash disbursements that have been made throughout the month. You know, considering whether those should be part of your financial statement package each month. Timing and distribution. Okay, so this is a hot button point for any of my CFOs out there. So financial reporting is only as effective if the right people get the right reports, and they have to be frequent. Reports should be produced at least monthly. Depending on the capabilities of your system and business, of course, you may be able to do more frequent reporting. Periods include current month, year to date, and any other meaningful groups. I love sometimes even to do a 12-month rolling. A lot of your accounting softwares will give you a 12-month rolling that you can dump right into Excel. Okay, timeliness. So this is my favorite one for all of you. So your reports need to be timely. Reports need to be provided soon enough in order for relevant decisions to be made. In no event should monthly statements take longer than 2 weeks into the following month. And hopefully they can be provided sooner than that. If your month-end close is more than 2 weeks out, the information is stale and irrelevant. You cannot make decisions if you go into the third week or fourth week of the month. Not everything has to be perfect at month end close. You can catch things in the next month, but at year end, that's when you want to have good cutoff. But it's very important that you are getting timely reporting out within the first 2 weeks of the new month. Otherwise, the information is irrelevant and it's too late to make decisions on what already happened because you're already on to the next month and probably on to next month close. Employee utilization may even be reported on a weekly or daily basis. Again, utilizing those dashboards, really easy to see utilization for if there's any project managers or principals on this call, it's really, you can utilize that. You can see what how chargeable your employees are and make some real-time decisions. Report distribution. It's critical just to outline, if you're a large firm, having a list of who gets what and ensuring that you know that that distribution is happening to the right personnel. And training. So it's very important that the folks that are getting these reports understand them. If you're a CPA, if you're an accountant, you've been doing this for years, numbers are your thing. But some of these project managers, that may not be. You couldn't go out and sketch a drawing, so don't expect that they're going to understand what a balance sheet income statement is. You're going to have to provide some training. And very often our clients will have us, Dannable McKee, come in and sit with the project manager group and walk through their financial statements so they fully understand it. That's very normal. You've got to do a lot of training so that they can make good decisions based upon these numbers. They've got to understand them first. So last thing is, well, second to last thing on this is that you need to obtain feedback. So what do they want to see? Ask them. What would be helpful for them to see every month? Ask. And then obviously distribute things electronically. That's pretty self-explanatory these days. All right, so analyzing and taking action. So effective financial statement analysis is a 4-step process. You need to prepare the proper reports, distribute them, perform the analysis, and make management decisions. It's critical that the analysis is performed. So many of you stop at somewhere in between 1 and 2. You've got to perform that analysis. You can go ahead and distribute reporting and then perform the analysis. That's okay. It's really important to get them out timely, but you've got to then spend a day and go through and really understand what's going on. Ask the questions, have meetings, meet with your project managers. All right, so analyze and take action. Financial analysis should be documented. So don't just do all this analysis in your head and have a couple conversations. Document it. Put it in an email. Put it in a Word document that's shared with the group. Keep it and have it so that it's formalized so that you can revisit the next month. All right, so my conclusion. So we've given you a lot of information today in this short hour. So again, we'll provide this to you at the end of this. We'll get an email out. You can always contact me if you have questions, if you want me to help you structure your financial statements a little bit better. Your chart of accounts, if your chart of accounts is a mess and you are nowhere near getting your income statement to how you should have it as I presented, contact me. We work with a lot of firms to really restructure and get you on the right path. So evaluating your financial analysis, consider whether you're doing the proper reports and whether they're being distributed to the appropriate people. Look at your financial statement analysis, consider improving the documentation and making sure that you're taking actions. Don't do all this work without taking actions and making decisions to get better, to get more in line with those industry standards. Sometimes change is needed to achieve improved results. Don't be afraid to change. I know that, dealing with architects and engineers, it's a challenge sometimes. They're very stuck in their ways. You know who you are, but you've got to be open to change because we all want to grow and we all want to see our firms succeed. Consider how utilizing your software best, how that can make your lives a lot easier. A lot of this reporting is already in there. Be certain to analyze the cost versus the benefit of any financial project. before making any decisions. So my name again, Charlotte Roth. Here's my email. Please email me if you have questions. Give me a call. We're here for you. We want to see your firm succeed and have the best tools to make all the decisions for your firm. So thank you again for attending. I think we are right up to the end. I don't see any more questions. But again, thank you for attending, and apologize that Vic was not going to be here, but hopefully you enjoyed myself as just as much. And until we talk again, bye-bye.